Thank you very much, Vince, and good morning, everyone. Very nice to be here. This morning I've got two presentations. The principal presentation is concerned with price patterns, but I think in order to understand how price patterns work, it's a good idea to take a look at some of the basic building blocks that go up to make these price patterns. And before I do that, I think it's important for you to understand where I'm coming from in terms of technical analysis. So I'm going to show you what my definition of technical analysis is. And the idea is that technical analysis is the art of identifying a trend reversal at a relatively early stage and riding on that trend until, and this is the important part, the weight of the evidence shows or proves that the trend is reversed. And this is very important because in technical analysis, people think we deal in certainties, but we deal in probabilities. And what we have to do is to have a number of different indicators all pointing in a similar direction, and then we have a greater degree of probability that the trend is reversed. We never know for sure. Even if we have a 90% probability that the trend is reversed, there's still that 10% of doubt where the trend may not be reversed. But obviously, if we've got the probabilities working in our favor, that's a very, very favorable factor. And the evidence that we look at are a number of different indicators, some of which we'll get into today. But it's important to understand also that the hopes and fears of all market participants are reflected in one thing, and that's the price. If I'm invested in the stock market, I'm obviously having an influence on the price because my money is in the stock market. But if you're not invested, you have an influence on the price too because your money is not invested. So it's the hopes and fears and the knowledge of everybody put together affects one thing, and that's the price. And that's all very well to know. But the important thing here again is that prices tend to move in trends. If prices didn't move in trends, we wouldn't be able to use technical analysis. It wouldn't work. And the other point is that once a trend gets underway, it tends to perpetuate. But prices in any freely traded market are determined by the attitude of all market participants to the underlying fundamentals. I don't believe it's the fundamentals which are important. I believe that it's the attitude of people to the fundamentals which is significant. To give you an example, in the 1960s, we had a group of stocks called the glamour growth stocks. They called them one-decision stocks because every year their profits went up and every year the price went up. So it was a one decision to make. You just bought the stock and held on to it. Then in 1973-74, we had a bear market which cut about 50% off the Dow Jones Industrial Averages. The growth stocks came down with everything else. But during the next 10 years, the market went up, but these stocks didn't make a new high until 1982, 1983, fully 10 years later. And yet most of those stocks experienced rising earnings throughout that whole period. So it wasn't the earnings that were important, it was people's attitude towards the earnings which was significant. And further we get along and look and study technical analysis, the more you appreciate the fact psychology is very, very important in understanding what's going on in the markets. And if you can look at the charts really reflect the psychology of people as they're trading. Another point is we have to assume a trend is a trend is a trend. Always assume that the prevailing trend is in existence until we have the weight of the evidence which shows or proves that it's reversed. So however much you may think that the stock market may be up right now, you have to have sufficient evidence to prove that the trend is reversed. You just can't go on a supposition that maybe the trend is reversed. You really need to have some evidence. And if you don't have sufficient evidence, maybe you've got 40% and you really need 55 or 60%, you have to assume that the current trend is still in existence. Give the benefit of the doubt to the prevailing trend until you have enough weight, enough evidence to show or prove that the trend is reversed. Now, there is no known technique for determining the duration and exact magnitude of a price move. We can only recognize a change in direction. In technical analysis, we have a few techniques which we'll be getting into in this session, which gives you an indication of where a price might go to. But we never know for sure where it's going. It's only an educated guess. It's an intelligent point in the charts for saying, okay, here we have an objective from, we'll say, a price pattern, which we'll talk about later, and it says the price is going to go to $10. That's a place for expecting the price to reverse. It's not one that we can say, well, the price is definitely going to $10, because, as I said before, there's no such word as certainty in technical analysis. We're only dealing in probabilities. And it doesn't matter what time frame you're following. The principles of technical analysis remain constant. So in the presentations I'll be showing you today, you'll be seeing some monthly charts, you'll be seeing some intraday charts. It doesn't really matter. If you're a long-term player and you see some intraday charts, don't get concerned, because the principles of interpreting these charts are exactly the same, whether you're looking at an intraday chart or a monthly chart. The only difference is that when you're looking at a monthly chart and you're looking at a certain price configuration, the implication is of much greater time duration than obviously if you're looking at a 10-minute bar chart. The other thing is it doesn't matter what security you're following. The principles of technical analysis remain constant. I often get people saying to me, well, you've written a book on so-and-so. Can I use this for currencies? Yes, of course, because the principles of technical analysis apply to any freely traded market, whether it's a currency, whether it's a commodity, whether it's a stock, whether it's a bond, whatever it is, the principles are identical. Because once again, when we're dealing with a freely traded market, we're dealing in psychology, and psychology more or less remains constant throughout the various markets. I'd like to mention, before I get into some of the building blocks, the difference between logarithmic and arithmetic charting, because I think this is a basic principle that everyone should really understand, because there is a difference when we plot our charts. There are two ways in which we can plot them. The first is an arithmetic scale. So here we have an arithmetic scale where each vertical distance measures the same point or dollar amount. So we'll say at this point here, the arrow represents $200, difference between 100 and 300. And then if we move it up there, it's another $200, the difference between $900 and $1,100. With the ratio scaling or logarithmic scaling, it's different, because the same vertical distance represents the same proportionate move anywhere on the chart. So once again, what we do is we take an arrow here. 500 to 1,000 is a 100% move. And up here, 1,000 to 2,000 is the same vertical distance, but it's the same proportionate move. And just to prove that the arrows are the same size, I can move them over here and over there, and you can see that they're the same size. So here's the point about using arithmetic or logarithmic charts. Here's a chart of the S&P Composite from 1900 to the year 2003. Now, in 1929, we had a bit of a correction, 85% decline, huge crash, a huge bear market. But it's hardly showing on the chart here. And yet over here, the 42% decline looks much larger, the one that took place between 2000 and 2002. So the arithmetic chart exaggerates when you get to higher prices and doesn't give you the detail when you're in the lower prices. The logarithmic is totally different, because here we can see a clear decline in 1929, and it comes up to its true proportion. And yet the 42% decline is no longer exaggerated. So whenever I can, I always plot everything on a logarithmic chart rather than an arithmetic chart. When you're dealing in intraday charts or charts that go on for extend for maybe 3, 4, 5, 6 weeks, where there's not that much price change, you really can't tell the difference between the charts. But when you're plotting for, we'll say, a year or 2 years or 6 months, and the price may go up 50% or so, there is a substantial difference between a logarithmic chart and an arithmetic chart. And the reason I like logarithmic charts, apart from this visual thing which I just showed you, is the fact that the psychology tends to move in proportions. And if you're plotting a chart in a proportionate way with a logarithmic scale, it tends to be much more accurate. We've talked a little bit about trends. Now let me just explain to you some of the important trends which I think go into making up technical analysis. We often talk about a bull market and a bear market. What we're really talking about here is the primary trend, the trend that revolves around a business cycle, which lasts approximately 4 years from trough to trough. And the primary trend lasts anywhere from 9 months to 2 years, and it's the dominant trend in the cycle. There is one longer trend, which we call the secular trend, which lasts for several primary trends, maybe 10 or 20 years, but we won't get into that one today. Bull markets are not straight up and straight down affairs. They're interrupted by intermediate reactions, and the intermediate trends last between 6 to 9 months. Typically what will happen is the bull market will start at the bottom down here, and people anticipate the next recovery. If, say, we're talking about stocks, they anticipate the next recovery. And then at this point here, some doubts begin to come in. Maybe some bad economic numbers come in, and something happens to cause people to anticipate that perhaps there won't be a recovery. So the price comes down, but since there is a recovery, then the price goes up again. So there's always a psychological reason that's given why the market reacts during the primary uptrend or the primary downtrend. So it gets interrupted by these intermediate trends. And then finally, we have the short-term trend, which lasts, say, from 2 to 6 weeks. It's a much more random in nature. And this is the trend that a lot of us would trade on. Important, though, to understand that we need to know the direction of the main trend in order to trade the short-term trend. Obviously, for a long-term investor, you want to be buying down here and selling up there. But if you're a short-term trader, you also need to know which direction the main trend is going in. Because if it's going up and you get a short-term buy signal, the chances are the market will have a much stronger move up. And if you want to go short in a bear market, you want to be going short at the top of these little short-term rallies. We can break this down even more to other trends for an intraday point of view, which I'll get into this afternoon on the presentation with the KST. But I just wanted to give you a sort of a basic overall view of the three principal trends here: primary trend, intermediate, and short-term trend. So I mentioned before that it's very important to look for the weight of the evidence, looking at several indicators to indicate a reversal. How many indicators do we need? I'm not really sure, but I don't think a lot of charting packages have 50 or 100 indicators in them. You don't need 50 or 100 indicators. Nobody uses 50 to 100 indicators. On the other hand, you don't want to use one indicator. However reliable it may have been in the past, I know from my own experience that an indicator will always at some point fail. So I think a nice number is maybe 4 or 5 different indicators, maybe 6 at the absolute most. Because if you have more than 6 indicators, you really can't follow what's going on. So what is the evidence that we're looking for? These are the building blocks in technical analysis, and they're the building blocks of price patterns. First of all, peak and trough analysis. Second, support and resistance. Third, trend lines. And fourth, of course, price patterns. And fifth, volume. And in this part of the presentation, we'll be looking at numbers 1, 2, 3, and 5, and then we'll be looking at price patterns in the next presentation. So let's look at peak and trough analysis. This is a very simple concept that was developed by Charles Dow in terms of the Dow theory. The idea that in a bull market, prices are zigzagging up, and you get a series of rising peaks and rising troughs. And as long as that condition holds, the trend, whatever you're monitoring, whether it's a short-term trend or an intermediate trend or a primary trend, as long as that holds, that particular trend is still intact. So when we're looking at these peaks and troughs, if we're looking at a short-term trend, we're looking at a matter of a couple of weeks or maybe as long as 5 or 6 weeks. If we were looking at an intermediate trend, we'd be looking at maybe 6 weeks to 9 months for each of these, and these would go up and make the primary trend. So what happens as we reach a peak, we get a failed rally. So the price fails to make a new high at this point just here, and then it breaks below the previous trough at point B. From this particular piece of technical evidence, the peak and trough analysis, that now gives us our sell signal, and the price goes down. Then, when the price goes down and starts to rise, at this point here where the green arrow is, that's when we get a signal of a series of rising peaks and troughs at point D. Because the price comes down, it rises, it tests the low, and then it moves to a new high. And when it moves to a new high just here, that gives us our buy signal. Now, just because the price then contracts again doesn't mean to say that it's a sell signal if it goes below the breakout point. Because at this point here, you've still got the series of rising tops, and you've still got the series of rising bottoms. And in this case here, the price then moves on up. So it's not until the price were to break below this low here that you would now have a series of declining bottoms. But in this case here, there's no sell signal, and the price moves higher. Sometimes things aren't quite as simple as that, because in this situation here, what we have is a series of rising peaks which are still intact, but at point X, we have a new low. So we have rising peaks, and we have a declining declining bottoms now. So we have a kind of a half signal. So what we need to do is to wait for the market to rally and then break below the previous low at point Y. Now we have broken both the rising peaks, because this peak is lower than that one, and we've broken the series of rising bottoms because this has now confirmed that. If we don't do that, then we could get a situation like this, where the price breaks down below the previous low, gives us half a signal, and then consolidates and move up. So remember, at this point just here, we've only got half the evidence. Half the evidence is bullish and half the evidence is bearish. So if that's 50-50, we don't have the weight of the evidence showing or proving that the trend is reversed. And this is why I said we need to have the weight of the evidence to show that the trend is reversed. Unless we have the weight, then we should assume that the prevailing trend is still intact. So it goes on to make a new high. So here in this chart here is an actual market example. And what I've done is I put just basically the waves of the rallies and reactions here. And you can see that here we have an uptrend with rising peaks and rising troughs. And at this point here, where the brown arrow is, that's the point where we have a sell signal because this high is not as high as that one. And this low, at this point here, we don't know that's going to be the low. But as soon as it goes below this point here, we know that we now have a series of declining peaks and troughs. And that's now signaling a downtrend. Here's another example where we have a series of rising peaks and troughs. And then the price comes down, so we have a lower high, and as it crosses below that arrow, we have a lower low. We don't know where the bottom is, but we now know that we have a series of declining peaks and troughs. And then we get a bit of a rally, and you can see that we now have a lower low and a higher high. Does this mean that the trend is reversed? No, because we only have 50% of the evidence saying that the trend is reversed. So now we have to look and see what happens. We get a reaction and a rally. And how do we know that this is a good point to say, well, this is an actual low? Well, one of the ways in which I determine whether we got a reasonable peak or trough is to look at the retracement. So in other words, let's say that's 100% of the move. As long as this correction is between 1/3 and 2/3 of this rally, and then we see a rally take place, then I can say that pivot point represents a legitimate trough. So the higher low means a new high from this rally will reverse the trend. In other words, if the price now moves above here, it's going to be bullish because we already have a higher low. So here's the price rallying up, and it's now taken out that previous high. So now we have a series of rising peaks and troughs. Here's one peak, here's the next peak, and there's one trough, and there's the next trough. So we don't know where this rally is going to end, but as soon as it goes across this point here, we know the price is going higher. And I'm measuring that on the blue line rather than the black line at that point. Then the price moves up, nice rally, comes up and tests the high, and the price comes down again. And that's a approximate 50% retracement. So based on the idea I was saying that a good peak or trough needs to retrace 1/3 to 2/3 of the previous rally or reaction, that represents a legitimate trough. So then what happens is the price comes up, and it fails. It's already failed at this high here, so we have a series of declining peaks. And now as soon as it goes through that legitimate trough here, we now have a series of declining peaks and troughs. And down it goes. Another building block which is very important are the concepts of support and resistance. And it's amazing, even a lot of professionals that I hear on TV sometimes say support when they mean resistance, and sometimes say resistance when they mean support. So what is support, or what are support and resistance? Support is where a declining trend can be expected to halt temporarily due to a concentration of demand. And resistance is the opposite. It's a point where an advancing trend can be expected to halt temporarily due to a concentration of supply. Support and resistance points are not predictors of where prices will go or reverse, but merely indicate probable points. Again, we're dealing in probabilities. It's an intelligent place, if you can identify, and we'll get into learning how to do this, potential support or resistance points. That's an intelligent place for expecting the market to turn. When we get to that intelligent point, then we have to look at our other indicators to see if they're going to agree with that concept. If they don't agree, then we only have one piece of evidence that the trend is reversed, and we have to throw it out until we get more evidence that the trend is reversed. So here's an idea of how peak support and resistance might work. The price comes up, comes down, I should say, then it comes up and it comes down. And a previous low is often a potential support or resistance point. So is a previous high. So this becomes support, and then the support is broken. And prices move down from A to B. Now you can see at this point here, this is a low, so it's a potential point for expecting prices to reverse. An intelligent point because that's a previous high or a previous low. In this case, it's a previous low. But what happens is, presumably at this point here, the other indicators aren't agreeing, and we go through a support level. Then we get to a support level at C. Well, obviously, the way that the chart is drawn right at the bottom of the chart, we're not going to be breaking this support level. So what happens at C is we get a rally and then a reaction, and again, the price comes down to support at point C. And what you can see here is the rally tends to be constrained at point B, which was previously support point. So what happens is that support on the way down, but on the way back up, it becomes resistance. It's kind of like if I'm on this floor here, and this is the basement. But if I was able to go down to the next level, I'm jumping up and down on the support. If I go down to the next level, and then I try and come up again, what was previously support down here, then becomes the ceiling to my advance. Same thing is true in the market. So support reverses its role to resistance on the way back up. So now the price eventually breaks through this resistance level and starts to rally. And we have another support level here. So on the way back up, this is an intelligent place for anticipating that the price may run into some resistance. So let's draw that line in there. And that becomes a potential resistance. And since I've fixed this example, obviously it does become resistance. And then it finally breaks through resistance. But what was resistance now becomes support. And if you extend that brown line and make it a green line, a support line, you can see that the price comes down and reaches support, and then finally moves on its way up. So resistance reverses its role to support on the way down, just as support reverses its role on the way back up. I'm just going to quickly go through this because, unfortunately, when I was doing this last night, I was choosing some additional slides, and I didn't delete them. So let's get through that. So what are the rules for determining support and resistance levels? Where they're likely to be? Number one, the more times a zone has been able to halt or reverse a price trend, the greater its significance. And that's pretty obvious. When you come down, rise up to a price, we'll say, and the price goes from $5 to $10 or 5 to 10 pounds, it hits that 10 level and then comes down and then goes back up to 10 and then goes down and back up to 10. 10 becomes a psychological point on the chart. So the more times that level has been hit, the greater its significance when it's finally violated. The next one is the steeper the price move preceding a given support or resistance zone, the greater its significance. And the best way I can demonstrate this is to give you an example. We have a door over there on that side of the room. If we'll say 12 feet away from that door and I start running at it, I've got a lot of momentum, I've got a lot of energy, and I can probably push through that door pretty easily. But if I come from over there and I come around the tables here and down to there, that's probably about 200 or 300 feet. By the time I get to the door, I'm going to be pretty exhausted, and the chances of my pushing through the door are not very good. And yet, in both instances, the door represents the same level of barrier that has to be forced through. But because I'm coming from a shorter distance, I can push through that door. Well, the same thing is true in the markets. If the resistance is at 10 and I come from 9, the price comes from 9, it's much easier for the price to go through that resistance than if it came from 1 or 2. So that's a very important thing to understand. The speed and the distance that you're coming from has an effect on how important that support or resistance level might be. And number 3, the more of a security that changes hand at a particular level, the more significant that level is likely to be as a support or resistance zone. So in other words, if everybody bought at 10, it goes down to 6. When it comes back up to 10, all those people that bought at 10, human nature likes to break even. All those people, or a lot of those people, are going to feed out the stock at that point. So the more stock whatever it is, whatever security it is, that changes hand at that particular level, the greater that level is going to be as a potential support or resistance level. Where are they likely to develop these support and resistance levels? Well, we already saw that a previous high or a previous low is a great place for expecting the trend to reverse. So here's a high, and the price comes down, and each time it comes back up to that resistance. That was an intelligent place for anticipating the price to reverse. Then the price goes up through the resistance and then comes back and finds support at that resistance level. Then we go up again. That is obviously a high. So when the next rally takes place, that's an intelligent place for expecting the price to reverse. So we draw a line at that high, and you can see that in this case here, it did have an effect temporarily on the price. Where else can we expect support and resistance points to develop? The upper and lower area of gaps often represent critical and important support and resistance levels. A gap on a chart is where the trading range today is between, we'll say, 4 and 5, and then tomorrow it jumps up to 5.5 and then goes higher. So there's a kind of a gap or a vacuum on the chart. It's an emotional point on the chart, and emotional points on the chart have very significant possibilities as potential support and resistance levels. Because once again, emotion is reflected in the charts, and prices are determined by psychology, people's attitude towards the fundamentals. So what I've got here is 3 gaps. Here's one gap just here, and you can see that the price comes down in a vacuum, and then it retraces that gap. And where does it find resistance? At the gap opening. Over here, we have another gap. Obviously, some panic selling takes place here, or determined selling. And where do we find resistance? At the closing point of the gap, just here. And then over here, another gap, a much bigger gap, much more panic selling this time. And where does the rally end? Just below the opening of that gap. So gaps are very important. And I think you can think of this in a way of 2 people having an argument. And they have an argument today, and they start to get very excited and start really shouting like crazy. And then they kind of feel, well, that was a bit foolish. I shouldn't have been taking that argument quite that extreme. So the next day, the 2 guys get together, they shake hands and say, look, please forgive me. I didn't mean to be that bad. Yeah, please forgive me too. So in other words, what they've happened emotionally, they've had the big excitement with the row, with the argument, and then the next day they retrace that emotional ground, shake hands, and it's all over. Same thing happens in the market. We get tremendous emotion when we get good earnings or bad earnings or whatever comes out, and then we retrace those emotions, and that's why the gaps are important, potential support resistance levels. Third way, I mentioned gaps are emotional points on chart, but there's other ways in which you can measure emotional points on charts. Sometimes you get a situation where the opening and the close are very high up in a price, and then during the session of the day, the price comes down a long way from the opening or the close. Or it might work the other way, where the opening and the close are down here, and the price runs up and basically comes back to where it started. This run up and this run down beyond the opening and the closing levels represent emotional points on the chart. And obviously, the greater the distance between the opening and the closing and where the price is at the low or at the high, the greater the emotion that we're looking at. So that's an emotional point on the chart, because you can see there's a little spike down just here. So in this case here, if you look back, which obviously we couldn't do if we were in the real marketplace, but you can see that point there had previously been an important resistance point, because we'd seen either actual rallies turn around there or they'd approached the same level. And approaching, I think, is just as important as actually touching. Then as we extend back in real time, so to speak, or extend forward, you can see that once that emotional point was broken, we got a pretty dramatic decline. So where would we expect the next rally to find some resistance? Well, obviously at that blue line. And what we see as we move up is at the blue line, there is some resistance and the price falls down again. So emotional points and charts are very important from the point of view of picking out potential support or resistance levels. Retracement points for previous moves, like 33%, 50%, and 60%, 66%, true and tried, tested technical concepts. Again, the idea that prices move in proportion. Fibonacci retracement levels, or even objectives, as we'll look at from price patterns later on today, represent important potential support and resistance levels. Again, remember that the market is determined by psychology, and psychology tends to move in proportion. So here's an example where we have a stock, we have a 100% move, down move from here to here, and this represents the retracement, 33%, 50%, 66%. 1/3 and 2/3, and then a 50% pivot point. So what we have here is we measure the move, and then an intelligent place for expecting the move to find resistance is at one of these points, either 33, where we have a small bit of resistance, or in this case 50%, where we have a large level of resistance. We don't know where it's going to stop. It could go beyond 50 to 66. But let's suppose at 50% here, we saw some overbought conditions on our momentum indicators, and we saw some other evidence that the trend was going to reverse. Then that would be an intelligent place for expecting it to happen. Over here, we see another retracement. This time, that pivot point, the 66% or 2/3 retracement, becomes important for that subsequent rally. So just because we've had one retracement, we move down to a new low, doesn't mean to say that these proportionate moves are any less important. Here's one more example where the price comes down. There's 100% of the move, and here again a 33% retracement. And a 50% retracement is where that rally finds resistance. And then we can move on, and you can see it then finds support. And then we've got support at 66%. Then we find resistance. And then finally, on the right-hand part of the chart, we find some more resistance. So retracement points of previous moves are an important point for anticipating potential support and resistance levels. Trend lines and moving averages also represent potential support and resistance points. And now it's time to talk about trend lines, because trend lines are part of our basic technical tools, but they also represent dynamic levels of support and resistance. Normally, when we think of support and resistance, we think of it as an actual number. And again, another point I should have made is that round numbers are often potential support and resistance levels. Numbers like 10, 50, 100, they tend to be potential support and resistance points. So how do we draw a trend line? First of all, we connect the first peak to the second peak and draw a line. And when that line is violated, that breakout is the signal that the trend line has been violated and that the trend is going to change. Sometimes it's a reversal. Sometimes it's a change in trend from down to sideways. But the important point when drawing a trend line, it's a very simple tool. And if I was on a desert island and I wanted to trade and I had a selection of 4 or 5 tools I'd take, trend lines being very effective, and they're one of the tools that I would take on the desert island. This is not a trend line. Why is it not a trend line? Because it's not touching anything. The line does not touch any peaks, and therefore it's not a valid trend line. And you'll be surprised at the number of people who draw a trend line on a chart and it doesn't touch anything. Well, a trend line, as I mentioned before, is a potential support or resistance level. So if this trend line isn't touching anything, how can it be a potential support resistance level? How do we draw an uptrend line? We connect the final low to the second low, and we draw that line and extend it up. And when we get a trend line break, that becomes our sell signal. Here's another trend line. Is this one a valid trend line? No, it's not, because the trend line only touches one point. It touches this point here. So why couldn't I draw the trend line along here or up there? Same ineffectual trend line. It has to touch the second point. That's what we call a primary trend line, when you get the final low to the first low, or the final peak to the second peak. But we can also draw a secondary trend line, which would maybe join, we'll say, this low here, and that low, and that low. It's not less significant. Sometimes secondary trend lines are more significant than primary trend lines. And I'll give you the reason why they are, because now we can look at the rules for determining the significance of trend lines. Well, the first rule is the longer the line, the more significant the trend line is going to be. And it goes back to the idea we're looking at the trends before. The primary trend is much more significant than the short-term trend. So if we're drawing a trend line that joins a lot of intermediate lows, and it takes a long time, like say a year or 2 years, that line, other things being equal, is going to be much more significant than if we're drawing a line on the hourly charts or the daily charts that extend over maybe 5 or 6 days. So the longer the line, the greater its significance. Number 2, the more times a line has been touched or approached, the greater its significance as a dynamic support or resistance zone. So in other words, if a line's only been touched twice, that's the minimum for a trend line, it's going to be nowhere near as significant than if it's been touched or approached let's say 5 or 6 times. And I say approach is just as important, because if a price comes down and it just touches the trend line, that's a touch. But if it just misses it by a little bit, that's still important, because the influence of the trend line as a support level is still as good. So I would judge that if it's been just slightly approached or it's touched, you count those as well. And the more times it's been touched or approached, obviously, the greater its significance as a dynamic level of support and resistance. And the same thing would be true of a moving average. If a moving average is touched or approached on many occasions and you get a decisive crossover, that moving average you can use as a reliable moving average. If the moving average is continually being whipsawed, then it's not a very good support resistance level, because it's being whipsawed. So the same thing is true of moving averages of trend lines. The more times a moving average has been touched or approached and then eventually is decisively penetrated, the greater its significance. Finally, in our order of our 3 categories of significance of a trend line, the steeper the line, the less significant the line. In other words, if we have a very steep trend line like this, it's an unsustainable trend. It's like someone running a 100-yard or 100-meter race. You're not going to keep up that pace for very long, so it's an unsustainable trend. And therefore, when it gets reversed or broken, it's not as significant as when the angle of ascent of a trend line, an uptrend line, is much less, because it's a much more deliberate trend. It's a much more sustainable trend. So trend lines, as I mentioned before, violations are either followed by a reversal or they're followed by a consolidation. So here's the price moving up. Here's the construction of the trend line. Not a bad trend line. It's been touched a number of different times. And then the trend line is violated. In this case here, the trend comes down. It goes from up to down. It changes from up to down. That is a reversal break, because a trend reverses direction from up to down. Here's another example, similar break, but this time what happens is the trend line, is the price moves in a sideways direction. So we have a change in trend, but this time instead of going up to down, a reversal, it becomes a consolidation. Here's a downtrend line, and the price in this case here rallies up, and so it's a reversal break. And then here's another one, and you can see that in this case here, the trend changes from down to sideways, so it's a consolidation break. In this case here, you can see that it eventually breaks to the upside, so eventually it's a reversal break, but immediately following, it's a trading range or a consolidation break. And of course, the 2 brown trend lines there are also trend lines. They just happen to be horizontal trend lines. So the 2 important things I think to remember about drawing trend lines. First, drawing trend lines is common sense. And second, trend lines are dynamic levels of support and resistance. And when I say common sense, I'll show you in a minute as to how we can compare 2 different trend lines and see which one makes more common sense. Because once again, technical analysis, we're dealing with psychology. And psychology moves in trends. So we've got to look at the trend line that basically reflects the underlying trend as the one we would take. Not necessarily the primary trend line, which joins the ultimate bottom to the first bottom or the ultimate peak to the second peak, but the one which seems to make more sense as indicating that the trend is reversed, that psychology has changed. First of all, though, let's look at the implication of extended trend lines. Because trend lines are a dynamic level of support and resistance. And remember, from earlier in the talk, we said that support and resistance reverse their roles once they've been violated. So here a line is very good as a support level. It then gets violated, but look at the extended trend line. The extended trend line reverses the trend line's role from one of support to one of resistance. So if it was very important as a resistance, as support up through here, it's going to be equally as important as resistance up there. So it's very important to look at trend lines and say, okay, we've got a violation here. A lot of people would say we've got a violation here, and then the price comes down, and they expect the price to go further. But what happens is the price then goes above the violation point. Well, if you were thinking of going short, this would be an excellent place to be thinking about doing it, provided the other indicators are in agreement, because this line represents potential resistance. And a lot of people would say, okay, well, that trend line no longer has any force, because we've gone back above this point, the breakout point. But it does have some force, some importance, I should say, or some significance, because the price has come up to that line as a resistance level. And the same thing we can see in reverse on a downtrend line. It becomes important resistance. Price comes down, but look what happens when it comes down. That's an intelligent place for anticipating some support. And maybe we can look at some other indicators, some oscillators we'll get into this afternoon, and maybe the oscillator is an oversold condition or diverging or what have you, and you see some other technical evidence at this point down here that the trend may be in the process of reversing. If it's in the process of reversing at a support level, what better place to anticipate and to buy? We mentioned before about angles of ascent. So here's a steep trend line, obviously unsustainable. So what happens in a situation like that is that we then need to redraw the line into something like that. So this becomes a much more common sense place for drawing a trend line, an angle of low angle of ascent with lots of touches indicating it's a good support level. And incidentally, if we're trying to anticipate, there's not that many ways in which you can anticipate whether you're going to get a reversal when the trend breaks, when the trend line is violated, or whether you're going to get a consolidation. But one thing I've noticed is that when you get a very steep angle of ascent or descent, the ensuing action for a while tends to be more of a consolidation, and then maybe the trend resumes at a slower pace. So looking at the steep angle of ascent or descent tends to be more of a consolidation type concept than a reversal concept. Here's an example where we're drawing a primary trend line joining the peak to the second peak, and that's line A. And then we draw a second line down here, which is line B. The question is, which is the more significant trend line? The longer line that touches the high and the ultimate peak and the first peak, or the second line, which is not as long? Well, the answer is, in my view, is if I'm drawing in a common sense way, this line here better reflects the underlying trend because it represents a much greater degree of resistance or barrier of resistance. See, it's been touched once, twice, 3 times, approached here 4, 5, 6, 7 times. That's a very important level of support. Also, of resistance, I should say. And also, this line here is violated sooner than that line. So if you bought at just this point here, you place your stop below the previous low because that's a support level. So you want to put it below the support level. And provided the risk was commensurate with your potential reward, that would make a good trade point. But up here, of course, your risk is much greater because you'd have to buy it here and put your stop down here below the previous support level. So the blue line is a much more intelligent, much more common sense place to draw a trend line than the green line. Here we see another line joining the peak at A. And this time, we can draw the peak, and it goes through this peak here. Draw a line at that peak there, and it goes through that there. And I personally don't worry about the fact that you're going through this line here. And I'll explain that a little bit later, because that represents an exhaustion move above this blue line. You didn't know that at the time. I'm talking about drawing the line when it's down here somewhere. But this, again, is still a better place to draw the line, the blue line rather than the green line. Here's some examples of trend lines. We're drawing the peak. We got it touched on numerous occasions on the way down. And you can see all the resistance points just here. So it's a good line. It's long and it's been touched several times. It's not that steep. And also, just to make a point, as we extend the trend line, in case you didn't buy at this point here on the breakout, you buy at this extended point here when the price comes back down to what would be potential support. In this case here, it had a nice rise. Trend lines and logarithmic and arithmetic scaling are quite important because it depends on how you draw your charts as to how the trend lines will turn out. Here's this is logarithmic scaling. And what I'm going to do on both, I've got 2 charts, one arithmetic and one logarithmic. And I'm going to draw a trend line joining the final low with the first low. Actually, that's the final low, I guess, but it would be this low here and that low there. And you can see that you get some resistance at the extended trend line. But the point here I'm trying to make is the line is violated in mid-December. Now we look at the arithmetic scale. The previous one was logarithmic. Now we look at arithmetic. And we're joining the same 2 points. This second low here and this low over here. We draw a line. We see in this case here we get a whipsaw break. But the line is violated in mid-January. And here's where the logarithmic line was violated. That was in mid-December. So uptrend lines are violated sooner on logarithmic charts than they are on arithmetic charts. With downtrend lines, it's the opposite. Here we've got an arithmetic scaling, and both these examples, we're going to join a high with the second high just there. And in this case here, it violates the line in mid-August. We can also draw two trend lines here. A nice double break, because if you've got two trend lines, what have you got? And both represent resistance. It's kind of like building a ceiling here, and we're putting in two levels of construction to make that ceiling much stronger. In this case here, our two levels of construction are two different trend lines, both of which in their own right are very good, both of which are residing in the same area. So when the price goes through those two trend lines, it has much greater significance than it has just going through one of them. So here's the logarithmic scale, and we join the final high to the first high, and you can see in this case here, the line is violated in late August. On the arithmetic scale, it was violated in mid-August. So on the downtrend lines, the logarithmic scale is violated. The trend lines on logarithmic scale are violated after they are on arithmetic scales. So here we see another example of an uptrend line. This is a 30-minute bar chart. But once again, if you're a long-term trader, don't worry about the 30 minutes. The principles we're discussing are identical for short-term charts as they are for long-term charts. But here we can see two trend lines approximately in the same area, and we get, in fact, a double break here. Over here, we get a similar situation, a very steep trend line. So it doesn't have that much significance, although it has been touched and approached on numerous occasions. What gives that point there on the violation significance is the fact you've got two trend lines being violated more or less simultaneously. Once again, each trend line is reinforcing each other, I should say, as a potential resistance level. So we get a double break. Here's another example where we can draw a trend line here, and you can see that every time the price comes up to the trend line, a lot of times it finds resistance. And it finds the resistance as it's approaching the line. Just here, I call that an approach. I could have put one in here as another approach. As you can see, it's been touched or approached on numerous occasions. And then at this point here, it just tentatively goes through. Well, sometimes in technical analysis, you want to get things pretty well perfect. You don't want these whipsaws. And there's a very good technique for getting around this. And that's just to make the line thicker. Here we see a similar example. This time we're using a moving average. Remember I mentioned before that moving averages represent potential support and resistance levels. And you can see here again that the moving average has been touched or approached on several occasions here. So based on the action on this period of the chart that we can look at, there is some very good resistance as marked by that 200-day moving average. Also, we can draw a trend line in the same area. So if you get a trend line and a moving average, or I should say a reliable moving average, both in the same vicinity, they have the effect of reinforcing each other, just like two trend lines. Here we see another downtrend line here, a green line, and then we can draw a blue line. The question is, which is the more significant line, the green line or the blue line? The blue line has been touched 3 times. The green line has been touched twice. But you can see that the blue line experiences this false breakout here. Well, when you get a false breakout, a whipsaw of that nature, I regard that as adding strength to the trend line. And this is the reason why. The trend line represents resistance. If I'm going up to the next floor, I'm trying to get through the ceiling, and I'm able to jump up and put my hands on the ceiling of the next floor, of this floor here, of this ceiling, or the floor of the ceiling, the floor of the next floor, which is this ceiling here. I can drag my head up, and I can sort of look over onto the next floor up. But then I get so exhausted, I fall all the way back down to this floor again. I haven't got enough strength to push myself right through that ceiling and up through to the next floor. So I come back down again. What happens when I come back down? It's worse than if I tried to get through, because I'm exhausted. I'm out of breath. I've got to recuperate and in order to make another attempt at this floor-ceiling combination. So when a price goes through a trend line like that, it means that the buyer, and comes back again, it means that the buyers are exhausted. And if the buyers are exhausted, you know who's going to take control? The sellers. And the buyers are going to have to regroup until they can make another attempt at that trend line. So when you see a false break above a downtrend line like that, it indicates exhaustion. and it actually emphasizes the significance of the trend line. So downtrend lines connect peaks, uptrend lines connect bottoms. Trend lines are not valid when they touch one or less points. Trend lines should reflect the underlying trend, the idea of drawing a trend line in a common sense way. Number 4, trend line penetrations should be decisive. Trend line violations signal both trend reversals and consolidations. And the trend line significance comes from the length of the line, the number of times it's been touched or approached, or the angle of ascent or descent. And exhaustion breaks emphasize the significance of a trend line. Finally, in our building blocks presentation, I'd like to talk about a few observations on volume interpretation, because volume is a totally independent variable from price. In most of our indicators that we look at, we're dealing either with price itself or with looking at a statistical variation of price. We're looking at an oscillator, that's derived from the price. But volume is a totally independent variable from price. And volume measures the intensity of market participants. So again, it's another way of interpreting what the underlying psychology of the market is. Volume trends, like price, zigzag up and down. Prices don't go straight up and straight down. They zigzag up and down. Well, volume trends too. So when we talk about a trend in volume, we're talking about an irregular, approximate rally in volume or expansion in volume or contraction in volume. So here we're looking at an uptrend in volume. But if you look carefully, you'll see that there was a down day here in terms of volume and a down day there. But the overall trend was up. So when I'm talking about volume expanding, I'm talking about volume expanding on a trend basis. And volume is also relative. It's relative to its recent past. There's no sense in comparing the volume, we'll say, on the New York Stock Exchange today with what it was 100 years ago, because there's absolutely no comparison because of the institutional changes that have taken place. So volume is only measured relative to the recent past. First rule, though, is it's normal for volume to go with the trend. If the trend is going up, it's normal for volume to expand. So here we see a rising trend, and we see a rising trend of price and volume. Volume going with the trend means that falling prices and contracting volume is normal. Prices fall because of a lack of bids, and down the price comes. That's a normal thing. It's not really telling us anything. The only thing it's telling us is it's normal. So if the volume is expanding and the price is expanding, that's normal. It's not telling us anything about a potential reversal in price. Here's another example. The price goes up and the volume expands, and the price comes down and the volume contracts. But here we see rising price and falling volume, and that's abnormal and it's bearish. So when you see the price moving up just here, and you see that the trend of volume is down, that's abnormal, and that is telling us something. That's telling us that this price is going up. But how is it going up? Are people enthusiastic? Are they going to push it up higher? No, they're not enthusiastic, because there's less and less buyers taking place as the price moves higher. So it's a negative signal, a lack of enthusiasm. Prices are going up not because buyers are pushing them up, they're going up because there's fewer and fewer sellers. So when the sellers come out, we get declining prices and rising volume. That's again a bearish situation. You see a number of examples on the charts where the price moves up on lower and lower volume, and then the first day or the first bar across here or the second bar, volume picks up noticeably. That's a very subtle hint that the price trend is reversed for that on a short-term basis. So here we have a bull market situation where the price is moving up and the volume is moving up, the price is moving down and the volume is contracting. A perfectly normal bull market type scenario. Same thing here. Then we can draw a line right at that peak there, because now we're in a bear market. And what we see during the bear market is that as the price is coming down, the volume is expanding, and as the price is going up, the volume is contracting. So if you're trying to figure out whether you're in a bull market or a bear market, or a bull trend or a bear trend, this is something you can look at to see what the characteristics of the volume are. You may not take any action on that, but you can put in the back of your head and say, hey, this is a bear market characteristic, so I should be looking to be going short rather than to be going long in this type of situation. Now I have to look around at my other indicators and see what they're telling me. Number two, volume leads price during rallies. So here we have a rally at A for the price, a higher high at B, and a higher high at C. But what happens to the volume is that the volume is making a series of lower peaks. So in other words, as the price is moving up, buyers are getting less and less enthusiastic. And it's a subtle sign that the price is about to reverse. It's not the only thing you would look at, but it's a red flag that says, hey, watch out, because as we're moving up, the buyers are less enthusiastic. And therefore, if the sellers start to move or the bids dry up, prices could reverse to the downside. High volume on a decline can sometimes be bullish. So here we see a situation where we get what we call a selling climax, because the price comes down, and as it comes down, the volume picks up to extremely high levels. That's the only situation that I can think of where rising volume and falling price are actually bullish, because the selling climax sort of clears the air of all the sellers. And then that leaves prices just one way to go, and that's up. Sometimes the selling climax will represent the final bottom, like it did here, and sometimes you'll get a trading range, and then a little while later the price moves down below this inflection point here. There's no way of knowing at the time. All you can tell at this point here from this particular study is that the prices are unlikely to take out this low for quite some time. And there's a good probability that it will actually represent the bottom for that particular move. So that completes what I have to say about basic principles of price patterns, basic building blocks, I should say. And in our next presentation, we'll look at actual price patterns themselves.